Hello, everybody. Welcome back to the Market Information Lab Valuation Bootcamp. My name is Jacob, and I'll be teaching you today about the discounted cash flow analysis. This is week 5 of the 9-week bootcamp. Today, we'll be going over the DCF, which is a discounted cash flow analysis, and our first intrinsic valuation. Previously, we went over relative valuation in comparable companies and precedent transactions. And again, this is going to be a two-part class. So the first class is going to be talking more qualitatively and talking more broadly about the valuation. And next week, we'll actually be diving into building out this DCF in Excel. So this week, more qualitative conversation about what goes into a DCF, how to actually build one. And then next week, we will actually be diving into building out in Excel. So without further ado, let's go ahead and talk about discounted cash flow analysis. For today, we have 1, the overview, 2, how to determine the free cash flow, which is important in your discounted cash flow analysis. Then we'll be talking about the discount rate, which we touched on a little bit in the financial topics conversation, is weighted average cost of capital, but we'll dive a little bit more into that. Finally, calculating terminal value and going over some key takeaways. The DCF overview. What is the intrinsic valuation methodology? So last time we talked heavily about what it means to be, what drives value, and last time we talked more about comparing your value to things that are similar to it. Intrinsic valuation is more theoretically correct, more based on sound finance theory. However, there are a lot of assumptions that go into this, so it's important to pay attention to that. But what is the intrinsic valuation? Is exactly that. It's based on the value of an asset based on its internal cash flows that the asset will generate. So if the asset is generating internal cash flows, it will not only have a market value, so what the market considers its value, but also it'll have an intrinsic value, right? So based off of these set of assumptions, we believe that the cash flows it will generate are X, and if the cash flows it generates are X, then its true value is Y. So that's what essentially intrinsic valuation methodology is we're going to be discounting the cash flows, similar to how we did in the financial topics section, and then we'll be determining a value for the company vis-a-vis the intrinsic cash flows. Another thing to note is that the intrinsic valuation methodologies are usually DCF. Other intrinsic valuations that use the internal cash flows can be the LBO analysis, which we will talk about in week 7 and 8, and accretion, dilution, or a merger model. So these are other valuation methodologies that you may see if you decide to go further into corporate finance, investment banking, those sort of jobs. So here, going through some of the pros and cons of intrinsic and relative. I know we talked a lot about this last week, but it's just important to go over. One, so if you're looking at intrinsic valuations, it's interesting to look at kind of the pros of that, and it's more indicative of the company's specific performance. So, as we talked about last week, there may not always be a perfect comp for this business, right? This business may be truly one of a kind. And because of that, it might be impossible to get a really great value based on the market. So that's one of the pros here is we can specify how the company is going to perform or how this is unique, and then we can discount it and value it appropriately. Another one is kind of the impedance of market prices. So as you know, at the time of this recording, quarantine and COVID-19 seems to be at large, right? So it's definitely changing the market price on a lot of different assets. So if you were trying to build a valuation for a company, market prices are down. So it's tougher to value a company truly based on the market price because the market price is being impacted by outside factors that may not be specifically related to your business. The last one is provides a lot of different scenarios on the outcome. Right, so we have the ability to change the assumptions. We can make a base case, management case, upside case, downside case, worst case scenario. And we can use different things in Excel to toggle between these to determine the value of this company. That isn't something that you're able to do with relative valuation. Relative valuation is very input, output, whereas intrinsic, you have all these assumptions that you can play with to see, what if analysis. for example. Some of the cons are very heavy on its assumptions. So that is not only a pro, but it's also a con. You need to have the right set of assumptions, or you're not going to get a very great output from your intrinsic valuation. And the last one is it can be difficult to forecast some of these assumptions. While going back to the COVID example, sometimes it's difficult to see what the future holds for some of these companies, right? Things like this outbreak may change business models, may change demand, may change supply, it may change certain input costs or margins. So it's extremely difficult to forecast some of these assumptions. Additionally, if you are trying to value something before this outbreak, it's tough to project out like a market downturn or something like COVID if it hasn't happened. Because of this, it can be really assumption heavy, and that's very scary to actually forecast the future correctly. Just quickly highlighting relative. I know we went over these more extensively last time, but relative is one, it's based on the market, and the market is always pricing, and they're always trying to get to that theoretically correct value. Two is it's much simpler, right? So you take a multiple and you multiply by your company's metrics and you're given a value. Some of the cons can be the difficulty to find truly comparable comps or transactions, and then sometimes it's driven by market psychology. So here we have again the pros and cons of the intrinsic and relative valuation. These are extremely important, especially if you're going to interview at an investment bank or corporate finance role, to understand why you would want to use which type of valuation. Now we're going to dive into a little bit more about free cash flow. So what is free cash flow? If you guys remember back to Fin 221, talked a little bit about free cash flow there. However, just a quick refresher, if you haven't taken that course, free cash flow is essentially the cash that is remaining after the business operations that is available to the company at their discretion. And the reason that we use unlevered free cash flow, which is what we'll be using, is because if you have control over the business, you technically have control of all of the cash flows remaining. So it's not important to go all the way down to net income, but instead we'll go into tax effective EBIT. Free cash flow is often used as a great metric because this is representative of all stakeholders of the business. It includes debt holders and equity holders, whereas if you went all the way down to net income, when calculating free cash flow, you would be removing those debt holders. And by removing the stakeholder, you need to make certain assumptions to adjust for this. The last thing is really important is free cash flow is made up of a lot of important components that we learned about in weeks prior, right? So we have capital expenditures and net working capital depreciation. Now, all of these, if you remember back to week 2's exercise, depreciation, net working capital, and CapEx have impacts on cash that aren't always being represented fairly in the income statement. So it's extremely important that we go through and make these adjustments for our free cash flow to really determine how much cash flow is available for this business. So free cash flow, as a quick reminder, the equation is your tax affected EBIT. So that's EBIT times 1 minus the tax rate plus the depreciation that year minus any capital expenditures and subtracting any changes in net working capital. So how do we use free cash flow? So essentially, free cash flow is the main thing we're trying to project. Now, you wouldn't just project out free cash flow as a percent of growth. No, instead, we want to project out revenue, cost of goods sold, and our operating expenses, all the important inputs that go into calculating free cash flow, projecting them out line item by line item for the next 5 years to give our free cash flow for the next 5 years. Then we will then take a discount rate, which is usually the weighted average cost of capital, which we'll discuss a little bit later. You will use the weighted average cost of capital and discount that to the present day. And that essentially is our theoretical discounted cash flow analysis valuation for this company. And essentially what is important to see and note here, and we even touched on this a little bit, relative valuation last week, companies are basing their values not on historical performance, but on the future performance expected. So this is why we are discounting the future instead of using some way of analyzing or adjusting the past performance to indicate the future. Now, the past performance is still important. It is where we determine and derive a lot of our assumptions. However, it's not it's not apples to apples whenever looking at the future. So it's very important that we make these projections. So, free cash flow in a DCF. So one of the assumptions we often make in a DCF is that a company is going to go on for forever. However, it is very hard to very difficult to project out free cash flow for 5 years for the DCF, and it's even harder to go years past this. For example, it's extremely difficult to calculate free cash flow of a business for the next 10 years or 20 years because you have no idea what the growth rate is going to be like. You're no idea how the cost structure will change in this business. So because of these things, we need to assume a terminal value, and the terminal value is kind of the quick hand way of saying that this company is going to go on for forever. We have no way to determine this value. However, we're going to assume a value at the end of these 5 years, and then we're going to just calculate that as present value, add it to our current value of free cash flow, and that is going to be our value. For example, it would be extremely difficult to project the growth of a high growth company for the next 30 years because at some point the company can no longer continue to grow at that rate, or it would be bigger than the economy. So for this reason, we often use the US GDP whenever calculating our long-term growth rate. Now, another thing to note is typically in the present value of the company or our valuation, the free cash flow usually represents 30 to 40% of the total implied enterprise value. And if you're kind of double checking your DCF, it's very important to make sure that this 30-40% number is correct, or you may have calculated something wrong. Maybe you need to go back and look at your assumptions. If more than 30 or 40% of your value is being driven by your not driven by your free cash flow, then you may need to go back and make some changes to your terminal value. Calculating tax affected EBIT. So this is pretty simple. We've walked down to EBIT multiple times throughout the course. However, going through it again, it's revenue less cost of goods sold less our operating expenses. And then after we calculate EBIT, we must tax affect this. One thing to note here is we must make sure we are subtracting out depreciation. Depreciation is an operating expense and it reduces our tax expense for the period. So because of these things, we need to make sure that it is being subtracted and then added back. Nothing else really to highlight here. Feel free to read through this slide. It talks a little bit more about calculating your tax affected EBIT. But essentially, whenever you're doing this, it's important to include your tax as a stakeholder because you will owe this money to the government, and it is a cash expense, and it does reduce cash flow. Depreciation amortization. So we've talked a little about this throughout the course, but depreciation and amortization is not a cash expense in the period of which it is being expended. However, it does reduce your tax impact. So because of this, we need to subtract it from revenue to get to EBIT. However, it does need to be added back because this is not truly representative of the cash being used or expended in the business. Amortization is very similar to depreciation, where it's a non-cash expense, more related to intangible assets or goodwill. Again, this reduces your tax impact. However, it does not reduce your cash. So as far as this goes, this is very accretive to your unlevered free cash flow. And this is something that you must pay attention to and make sure you're paying attention to the signs, make sure your depreciation is increasing free cash flow whenever you're building out a DCF. Going towards kind of calculating your depreciation, oftentimes we'll use depreciation as a historical percent of revenue or a percent of PP&E when we're projecting this forward. And it's really important to note that depreciation is not a cash expense, and that this add back of cash is extremely important whenever going to unlevered free cash flow, because of the fact that it doesn't reduce your actual cash in the period. And then here are a couple of common interview questions, as well as kind of applying some complex depreciation amortization to your model. This isn't something we're really going to go over in this class. However, feel free to pause the video, read a little bit more about it, maybe ask yourself some of these questions. This is some of the things that you may see if you're going into an investment banking interview. Capital expenditures. So, we talked a little bit about this, not only in the financial statements, but as well in kind of financial topics. But, whenever you're buying a business, you'll see CapEx, and CapEx represents the increase in your long-term assets, such as plant, property, and equipment. And this is extremely important in a business, right? You want to see CapEx continue to grow, which simulates and represents the management's thought process behind this company growing, right? If the company is growing, they need more equipment, they need more plant, they need more property, they need more warehouses, et cetera, to continue to build this operation. However, capital expenditures does not show up on your income. It is not represented in net income. So it's very important that we subtract this because the company is paying cash to grow their business vis-a-vis the PP&E, right? So if you do not subtract this, this is not truly representative of the free cash flow available after operations. So it's extremely important, and this is why it's part of the formula. So capital expenditures, kind of getting more deep into capital expenditures, you have maintenance capital expenditure, and then you also have growth capital expenditures. Oftentimes, this isn't broken down for you whenever you're looking at a large company's 10K. They're not going to say, oh, this is how much was going in towards maintenance, this is how much is going to growth. However, it may be broken down, and it's a very interesting thing to note. Additionally, if you're going to work more closely with a company, whether you're at an investment bank or a private equity firm, you are more looking towards looking at how much is maintenance and how much is growth. And looking at how much you can get away with to increase your value in an LBO. Though we'll probably get into this a little bit more in the LBO class. Capital expenditures is often calculated as a percent of sales, very similar to depreciation amortization, because usually if your sales are growing, then you need to see capital expenditure growing. This is a very quick and dirty way to do capital expenditure as a projection. However, it tends to be very, very close to what it will actually be. Again, here are some common interview questions and some more complex modeling of plant, property, and equipment. So feel free to pause the video here, read a little bit more about this. However, we're not really going to be diving that deeply into this at this class. Understanding net working capital. So net working capital, though we talked about it a little bit in the financial statements class, we talked about its impacts on the cash flow statement. For example, if its current assets go up, then cash goes down, and if it's a current liability going up, then cash will go up. Because of this effect, net working capital is extremely important to track when we're calculating free cash flow. So net working capital is the main indicator of how efficient a business is running. Essentially, what it shows us is how much cash is tied up in the current operations of the business. Now, within a year, what is required in cash to grow this business, to operate this business, right? So you see cash being reduced to buy inventory, to pay for insurance, to prepay any expenses, maybe it'd be rent or insurance. Additionally, you're also seeing cash being tied up in accounts receivable, which is money waiting to be received by the company, by your customers. Additionally, you're seeing the increase in cash by not having to pay off current liabilities, whether it be accounts payable or accrued liabilities, things that you owe either your creditors or people who are your vendors, or possibly people who are working for you. So all of these could be accrued liabilities or accounts payable or short-term. This is extremely important to track because this does have a material impact on cash and the cash available in the current period. And another thing that's really important is, if you're higher net working capital, it shows that you have strong liquidity, right? So if you have less current liabilities than your current assets, this can be an indicator of a stronger business model, or a business model that's less susceptible to something like a liquidity crunch, where you have possible doubts about your ability to pay off your creditors. So then here again is the formula down below. Oftentimes when we're working in a model, we use net operating working capital. The reason for this is because we don't want to count cash and cash equivalents, because you do not want to double count cash at any point during this model. So we have current assets less cash and cash equivalents, current liabilities less your current portion of long-term debt. The reason we subtract out long-term debt is because we want to make sure all of the stakeholders are being considered here, and the long-term debt holders are being considered elsewhere. Change in net working capital, this kind of goes over what we were talking about If your current assets go up, your cash goes down. Current liabilities go up, your cash goes up. So because of this inverse relationship, it's extremely important to know and be looking for these relationships when actually building out your model. If your model, if you witness a cash increase, you want to make sure that your net working capital decreases. Make sure that you are watching kind of this relationship, because this is where a lot of people will get confused and mess up their model because it's a very complex topic. And then here is kind of how we were projecting out the net working capital later on in the class, but it's important to kind of break down each of the current assets and liabilities into their perspective line item and project them out accordingly, because it may not be fair to just assume that this to assume that net working capital is going to grow at a percentage. So oftentimes what we'll do is we'll break down accounts receivable, inventory, accounts payable into what we call days receivable, days payable for your accounts payable, and then inventory held, days inventory held. So these are all metrics that will allow us to project out each of the line items much more easily. Additionally, prepaid expenses, other current assets, other current liabilities tends to be based on a percent of revenue, just because as revenue grows, oftentimes you'll see these line items grow. So throughout this whole entire thing, hopefully you watched and paid attention to how we are projecting out a lot of these line items based on historical periods, using and tying them to metrics that make the most sense when projecting these out. That way we can get the best and most accurate analysis. Last thing to note here is you want to make sure you're subtracting the change. So for example, whenever you're looking at your free cash flow calculation, you wouldn't subtract in the first year the 1,302 because this is not the change. You would want to subtract out in the second year the 3,877 because this is the change in net working capital. Make sure you are subtracting out the change and not the total net working capital number, because the total net working capital number is not what you are subtracting. That's not what the change in cash is. The change is the actual number, that is the change in net working capital, because this is what the impact is on cash. I know that is a little confusing, but it should hopefully make a little bit more sense as we begin to build out the model. It's important to note that you're subtracting the change, not the total net working capital. And then here are some final interview questions that you'll possibly see if you're interviewing for some of these corporate finance jobs, investment banking jobs. So feel free to pause the video, write these down, maybe look up the answers on Google. If you're having any troubles with any of these interview questions, feel free to email the Market Lab and we can have one of our fellows walk you through them a little bit more closely if that's something you're interested in. Awesome. Now we're going to dive a little bit deeper into weighted average cost of capital. So weighted average cost of capital is essentially a discount rate. I know we talked a little bit about discount rates, whether it be the required rate of return in week 3 or the weighted average cost of capital. Essentially what the weighted average cost of capital is, for the people who haven't learned about it yet in Fin 221, is the weighted average. So basically the average based off their current capital structure with relations to their equity and debt financing. So if you have 60% debt financing and 40% equity financing, this weighted average cost of capital would have 60% weight on debt and 40% weight on equity. So that is kind of how the weighted average will then be calculated. Then you have not only the cost of capital perspective to each forms of capital. So essentially what we're trying to do here is trying to figure out what the discount rate should be, or the prospective risk associated with each of these forms of financing, taking a weighted average of those to then determine our discount rate. So as you can see at the bottom, we have the actual calculation. So you see the calculation is your cost of equity. So that can be determined either through the CAPM model or by just plugging in a hard percentage. Then you also are calculating the weight. So that is the total equity, your market capitalization, not the book value of equity, the market capitalization divided by the market capitalization plus the outstanding debt. So the equity, total equity, so your market cap plus the outstanding debt, gives us something called the total capitalization. The total capitalization is just the amount of outside capital used to funding your business. And this is really important whenever we're looking at the weighted average cost of capital. You will then add the cost of equity times the weight of equity plus the cost of debt. So this can be found in a couple different ways, whether it be their most current debt issuance, or this could be by taking an average of the current debt issuances times 1 minus the tax rate. This is important to note because the debt is tax deductible. Therefore, we must tax shield the required return because of this cash incentive, because of the tax shield. Then you will divide the total amount of debt over the total capitalization, or the debt plus the market cap. So I know that's a very involved formula. Feel free to spend a little bit more time here if that's a little confusing. And definitely as we continue to build out the DCF in our Excel class next week, this will become a lot easier to maneuver and hopefully a lot easier for you to understand. So we did go over a lot of this, the weighted average cost of capital, the cost of debt and equity. There's a lot of different ways you can determine these. A lot of times when we're using cost of equity, we're going to be using the CAPM formula. And for cost of debt, oftentimes you'll use a given valuation metric, whether it be from Bloomberg, or it could be based off their current interest expense divided by their long-term debt. And then the cost preferred equity is oftentimes just given to you on a dividend yield payout on the preferred stock. So some last couple of calculations for you. If you haven't learned about the CAPM formula, it's provided here. So your cost of equity would be your risk-free rate of return plus beta times your market risk premium. A lot of these numbers are, again, in DCF subject to assumptions, but a lot of times you'll see the risk-free rate be the 30-year treasury, and then the market risk premium has recently come out to be like the 10-year average on the S&P 500, so that's coming out to be like 8-9%. Cost of debt, a lot of times we'll just use Bloomberg. That's usually what I use whenever I'm building out a cost of debt assumption in my DCF. Another way that you can do this is taking your interest expense and you're dividing this by the total long-term debt. Again, here are some common interview questions related to weighted average cost of capital. Feel free to contact any of the fellows if this is something that's confusing to you. But again, it should be pretty easy to understand as we begin to build this out conceptually in the Excel class. Calculating terminal value. So terminal value has two main methods. However, the method you'll see most commonly is called the exit multiple assumption, or the exit multiple method. So essentially the DCF analysis, like we talked about earlier, it's impossible to project out your free cash flow till the end of time. Simply one, because you have no idea how long this company is going to be around or what may end this company's life. And two, if you were to do this, your free cash flow projections and assumptions are going to be wildly wrong by the end of 40, 50 years of projections, and it just makes no sense to project out some of these line items. So what we'll do is we'll take an exit multiple, an assumed exit multiple, usually driven by your comps or precedence analysis, and then you're going to apply this multiple in the terminal value. In the exit multiple, essentially what you're saying is you're going to take the exit multiple. So if that's EV over EBITDA, for example, you're going to take, let's say 10 times as your multiple. You're going to take your 10 times multiple and then multiply that by your terminal year EBITDA. That is going to be your terminal value, so what you believe the value of the company is at the end of the period. You're going to multiply it by your prospective terminal value year, and then you're going to discount that as well with the free cash flow to determine your final value. Terminal value is extremely important because it does make up usually 60 to 70% of your value whenever you're making up a DCF. A lot of times, it's important to note that exit multiple is not always theoretically correct. If a company is holding on to this investment more long term, if you're selling to a strategic acquirer, then it doesn't make a whole lot of sense to use exit multiple whenever you're valuing the company. However, due to kind of the prevalence of private equity and the possibilities of private equity buyer, a lot of times in the market now, as an investment banker, you're asking yourself, what value are you going to get for this company if you sell in 5 years? And this is why we've seen a lot of the shift in DCFs tend towards the exit multiple, not only because it's easier, but because of the relevance of the private equity market. Additionally, we have the perpetuity growth rate method. Perpetuity growth rate method is, again, the financially more sound way of more theoretically correct way to calculate the terminal value of a company. It's based off the Gordon growth calculation of kind of an annuity. And essentially what you're going to assume is you're going to assume a growth rate till the end of time. You're going to multiply your terminal value free cash flow by this. Then you're going to divide by your WACC less your perpetuity growth rate. And a couple things to note here is you need to make sure that your WACC is greater than your perpetuity growth rate. And then you also need to make sure your perpetuity growth rate makes sense. So as I spoke about earlier, it doesn't make a whole lot of sense to have your perpetuity growth rate be greater than the size of the US economy, because what you're saying is you believe that this company will grow faster than the US economy at some point, and that is not a fair assumption to make. Again, perpetuity growth rate is more talking about if we add this company to our portfolio, how will it grow into eternity, right? So if you are a strategic buyer, let's say you are Apple and you're buying, another cell phone manufacturing company, you're saying, how are we going to see this company continue to grow past year 6 till eternity? And what value are we placing on that? And perpetuity growth method is oftentimes the best way of adding this value to the DCF. Again, here are some final common interview questions for terminal value. Again, feel free to pause the video and read through these, see if you know the answers. If you have an interview coming up, this is a great place to come back and see kind of what some of the technical interviews may look like regarding terminal value in a DCF. So that kind of concludes our overview of the DCF and kind of the components. Next week, we'll be diving more into how to actually build this out in Excel, a more practical approach. And we're actually going to be using Chipotle, the example we used from last week, to build out a DCF and determine the value. So just some key takeaways here. One, DCF is important type of valuation because it is the most commonly used intrinsic valuation. And intrinsic valuation is important because it's based off the internal cash flows instead of based off the market. You need to make sure that you discount all of your future cash flows. That way it represents the time value of money and the finance topics we talked about in week 3. And it's important to remember that you always want to discount to today because you're more concerned about what the asset is worth today instead of projecting it in the future. Another thing that's really important is you want to make sure you're calculating the terminal value that makes the most sense with your type of buyer. For example, if you're only selling to private equity buyers, it doesn't make sense to have a terminal value that is based off the Gordon growth rate method because no private equity buyer is going to want to hold this investment for forever. So in conclusion, a DCF valuation of 4 steps. It's important to project out our shorter term free cash flows, calculate our discount rate using the weighted average cost of capital, calculate your terminal value, and discount the terminal value to present day. Take the present value of your free cash flows and add the present value of your terminal value to get your total implied enterprise value. DCFs are super heavy on assumptions. So please remember that whenever you're building out a DCF analysis, make sure you're using realistic assumptions. Anybody can get a DCF to spit out whatever number they want. So it's important that you know about your assumptions and you're really being thoughtful about your assumptions, or your DCF could be a meaningless wasted time whenever you're looking at valuation. Thank you guys for tuning in. Next week, we'll be going through the actual Excel, followed by leverage buyout in week 7 and 8. Thank you guys for coming. Have a great rest of your day.